Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 23rd of February. Let's dive into the week's top market news. European markets hit records amid macro resilience and institutional uncertainty. The European equity landscape showed remarkable relative strength last week, culminating in a new all-time high for the Pan-European Stocks Europe 600 index, which closed with a 2.08% gain in local currency. This bullish trend was fueled by upward revisions in corporate earnings expectations and broadly encouraging macroeconomic data. Furthermore, it reflects a clear investor appetite for diversifying portfolios away from the technology-heavy U.S. market, currently characterized by stretched valuations. Among major national indices, Italy's FTSE/MIB plus 2.29%, France's CAC 40 plus 2.45%, and Germany's DAX plus 1.39%, all posted gains, while the UK's FTSE 100 reached new peaks with a 2.29% weekly increase. On the real economy front, the Eurozone's outlook remains multifaceted. Eurostat data for December industrial production showed a 1.4% sequential contraction, a result weaker than consensus estimates. Despite this sign of weakness, preliminary PMI readings for February provided a positive surprise, signaling that new orders rose at their fastest pace in nearly 4 years, suggesting a potential turnaround for the manufacturing and services sectors. Conversely, investor sentiment in Germany showed signs of softening. The ZEW Economic Sentiment Index unexpectedly fell to 58.3 points in February, retreating from the 59.6 peak recorded the previous month. Institutional debate was dominated by speculation regarding the leadership of the European Central Bank. Although President Christine Lagarde reiterated her intention to complete her term through October 2027, reports of a potential early departure triggered strategic positioning among member states. Spain was the first nation to openly declare interest in the top ECB post, with the economy minister confirming the country's active commitment to securing a position of significant influence and leadership within the Eurotower during the succession phase. In the United Kingdom, inflationary dynamics show signs of stabilization that could pave the way for monetary policy easing. CPI inflation fell to 3.0% year-on-year in January, reaching its lowest level in nearly a year, driven by falling fuel prices. Simultaneously, the labor market is showing signs of cooling. The unemployment rate rose to 5.2% in the quarter ending in December, a 5-year high, coinciding with a slowdown in wage growth. This evidence has bolstered market bets on a potential interest rate cut by the Bank of England as early as the March meeting of the Monetary Policy Committee, even as inflation remains above the 2.0% target. Now our insight into alternative markets. Reimagining AI valuation and due diligence for the industrial age. In the contemporary mergers and acquisitions landscape, artificial intelligence has evolved far beyond its origins as a niche IT project to become a cornerstone strategic asset that fundamentally reshapes the way corporate valuation is approached. For private equity firms focusing on industrial sectors, the primary challenge is no longer just identifying technological adoption, but rather distinguishing between a superficial implementation and true structural integration. This distinction is crucial because AI now acts as a primary lever for either creating strategic alpha or accumulating significant operational debt, a reality that necessitates a far more sophisticated and evolved approach to the traditional due diligence process. The integration of AI significantly influences four core financial variables that demand close scrutiny from any financial analyst. First and foremost, it acts as a powerful force multiplier for operating margin expansion. In companies that already possess robust and well-documented processes, AI accelerates margin growth through intelligent automation and optimization. However, in disorganized organizations, the technology often merely serves to automate existing chaos, which can lead to increased costs without providing a proportional return on investment. Furthermore, modern valuation must now account for operational continuity risk by evaluating the resilience of AI systems. A non-governed integration can lead to sudden and catastrophic value destruction through security breaches or algorithmic errors, effectively creating a high-stakes scenario for the entire investment. From a broader financial perspective, robust AI governance helps optimize the cost of capital by making operational outcomes significantly more predictable. By reducing the perceived volatility of the business, companies can lower the risk premium demanded by investors, which directly benefits the weighted average cost of capital. Ultimately, this leads to a sustainable enhancement of enterprise value. In this context, AI should be treated as a long-term strategic asset that contributes to the terminal value of a firm by creating a defensible and scalable competitive advantage, rather than being viewed as a tool for a temporary or fleeting efficiency gain. Moving beyond traditional financial metrics, modern due diligence for private equity firms now revolves around three critical operational pivots that define the quality of the target. The first major pivot is a focus on accountability and leadership, where it is essential to identify a clear chain of command. A high-value target must have designated owners for both AI business outcomes and associated risks to ensure that the board of directors remains consistently informed of any critical process impacts. In parallel with leadership, analysts must rigorously examine the integrity of the data estate. This involves verifying the provenance and legal basis for the use of data, as a lack of traceability can expose an investor to significant regulatory and legal liabilities, particularly under emerging frameworks such as the EU AI Act. Finally, technical control systems have become a priority, requiring due diligence to confirm the existence of continuous monitoring and kill-switch mechanisms that prevent algorithmic drift and protect the firm against industrial accidents or long-term reputational damage. This shift in analytical scrutiny has led the market to differentiate valuations based on a firm's technological and governance maturity, resulting in three distinct corporate profiles. The traditionally efficient firm possesses solid and predictable processes based on classic operational models. While they are often valued at standard industry multiples as a safe bet, they frequently lack the exponential scalability offered by their AI-driven peers. On the other hand, companies that successfully integrate AI within a rigorous control framework earn a multiple premium. The combination of margin scalability and mitigated operational risk justifies a valuation well above the industry average, as investors view these entities as having protected, high-growth cash flows. Conversely, firms that adopt AI without a structured governance framework often suffer a significant multiple discount. Despite potential short-term efficiency spikes, the accumulation of hidden debt, ranging from legal liabilities to vendor lock-in, makes the investment unacceptably risky and forces analysts to apply a more conservative valuation. In conclusion, the integration of AI represents a generational opportunity for the industrial sector that demands a higher level of analytical vigilance. For a private equity fund, true value creation is derived not simply from the act of adopting technology, but from the disciplined governance of that technology. A winning strategy typically involves a barbell approach, which entails deploying low-risk, high-volume AI use cases to stabilize the corporate core while simultaneously scaling high-value initiatives under strict oversight. Ultimately, in the current market environment, transparency and governance have emerged as the true drivers of acquisition multiples.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.